Hello, everybody. Welcome to today's webinar with Horizons ETFs, where we'll be discussing preferred shares, where we're going to get a 2023 outlook with Fiera Capital and Nicolas Normandeau. Just before we get started, I just wanted to set the agenda and with some housekeeping issues. We'll look to have the majority of the webinar done in about 40 minutes, with some questions either throughout or at the end. If you are interested in asking a question, there is a question bar on the toolbar on this webinar where you can type in a question at any point during the webinar, and I can give a reminder at the end as well. And if you do ask a question, we'll do our best to answer that throughout the webinar or at the end. And if we don't get a chance to answer all questions, we'll do our best to reach out to you afterwards. So again, my name is Jeff Lusick. I'm the head of the retail sales team here at Horizons ETFs. We thought it was a great time to provide an update on preferred shares and specifically find out if there's an opportunity right now within the preferred share space. We've started the year off quite well in January of this year after a bit of a roller coaster. 2020-21 were great years for preferred shares with the issuance of LRCNs, leading to issuers redeeming some preferred shares at par. And then 2022, last year, yields spiked quite aggressively, which is usually good for preferred shares, but credit spreads widened significantly, leading to a negative year along with most asset classes last year. So that's why we figured it was a good time to have this webinar now, provide an update, and find out if there's a good opportunity with preferred shares, not in both the yield as well as potential upside. So with the agenda, we'll be going through that update. We'll be talking about the opportunities in HPR and HYBR. Those are the preferred share mandates here at Horizons ETFs. Just a reminder of our partnership with Fiera Capital. We've had a partnership for over 10 plus years. Very proud of our partnership with Fiera Capital. They've done an excellent job sub-advising many of our active fixed income mandates, and a true institutional asset manager that we're able to have sub-advise our ETFs that we can offer to both the retail and institutional marketplace with true active management at a very fair fee. So in that lineup, of course, is the preferred shares, but there's a lot of other mandates, including some investment-grade bonds, and we also see that opportunity in bonds right now as well. So today, as I said, we'll be looking at the opportunity. Is there potential for a recovery? Credit conditions appear to be improving after deteriorating last year with spreads widening. Valuations are becoming more attractive, and you are getting a really nice attractive yield carry over other fixed income right now in preferred shares. As Nick will present, we're looking at yields of in excess of about 6% for the foreseeable future, especially in the rate resets. So that's an opportunity, and the valuations that they're providing right now. So Nick Normandeau has joined us today. He is Vice President and Portfolio Manager of Fiera Capital. I like to call him Mr. Preferred Share. He's been on that team for 18 years. He's been on the mandates managed with Horizons since inception on HPR. So that's great to have his experience with us. Of course, he's a Master's of Science in Finance as well as a CFA. So we're lucky to have Nick. So Nick, thanks for joining us. I really wanted to pass it over to you to get your thoughts on the fixed income market, preferred shares, and where you see the opportunities right now.
Thanks, Jeff. Thanks everyone to be on this call. Yeah, it was a challenging year last year for fixed income, including pref. I would say it's a good start so far this year, but we're expecting again some volatility this year in the pref market and also in the fixed income market for 2023. So maybe I'll start with some market backdrop for what we're seeing right now. There's a little bit of difference with Canada and the US. I would say first, if we start with Canada, we're kind of seeing that these hikes that the bank is doing, have been doing since last year, they kind of start working, right? We're seeing inflation that we had the number yesterday. It's kind of start to decrease from the peak, right? So it's still high at 5% year over year for the core measures. But when you looked at the last 3 months for the core measures, we're now running at 3.5%, right? So not yet at this 2% target, but getting close, right? So that was a bit of the reason why the bank has decided 2-3 weeks ago to be on pause, right? Pause of hiking, right? So they're not at all close of starting to cut rates, right? But we think that they can be patient enough and see all the hikes that we saw to be kind of put more in the economy. So it takes a little bit of time, and we've done some analysis, and like if we start seeing inflation numbers for the next, like let's say until June, increase by 0.3% per month, the year-over-year number will be around the low 2.3, 2.5%, right, in June, right? So that's why they need time. So that's why they can be patient right now and being on pause, which is great, I think, for the credit environment. As for the Fed, though, it's a little bit of different story. We're seeing a little bit more pressure on inflation now. They've been revising their number, right? And the year-over-year number, the last 3-month number for the core measures are kind of increasing and now are at 4.5%. So and increasing. So clearly, it's not going into the right direction. Unemployment is really, really low. Job creation is on fire. Retail sales is on fire. So on the Fed, they have more job to do. They have to continue to hike, right? So that 4.75 right now, for us, we think that's they easily are gonna have to hike another 50 beep, right, towards 5.25 and potentially higher a little bit, right? So, but they're close to be done. So probably they'll be done around June this year, right? So, but let's see, right? There's clearly more risk, I would say, in the U.S. right now.
And then Nick, you expect those to stay at that level right through 2023 once they hit that?
Yeah, both the bank and the Fed, there is zero cut expecting from both this year. Inflation core will be sticky around the 2-3%, right? And yeah, potentially at some point in 2024, they're gonna start cutting rate. That's what the market is pricing, by the way, to start seeing cut now in 2024, potentially 1 or 2 by March or June, depending which central bank's looking at, right? So, and we agree with this. And at some point when we are through all this inflation problem, maybe it's in late 24 or sometimes in 2025, they're gonna go back towards 3%, right? We just think right now it's way too soon. And the market, 3-4 weeks ago was pricing some cut this year. We thought it was way too soon, and since then, with the numbers, they have completely removed those potential cut this year. So that's more for us, we think, a 2024 story.
And so you think it gets down to sort of that normalized rate is in that 3% range, and is that what the inverted yield curve is telling us right now?
Yeah, that's exactly what it's telling us, right? But 10-year Canada's and 5s and longs, same for the US, have been increased, right, over the last month. Start the year really like going down and down by 50, 60 beep, and now we are back up towards slightly above levels we reached at the end of last year. So I would say 10-year Canada, 340, 350, it is cheap, right? And I know it's a preferred share webinar, but for us, we are buying duration here. Buying bonds makes total sense at these levels. And of course, you need to be patient for 12, 18 months. But at some point when we're out of this inflation problem, rates will potentially be slightly lower than 3%, right? So for the 5, 10s and long. So there is clear upside right now with bonds right now.
So got attractive yield now and potential upside when yields go down. Okay.
As for credit is doing really well this year so far. Spreads are tighter by almost 20 basis points, right? Same, a little bit less in the US, but also doing really well. For us, we were kind of expecting some volatility this year, so it's going well. we're thinking that if the Fed needs to continue to hike and hike, we could see some pressure, right? But spreads are kind of okay level to start, right? So we're thinking maybe 2025 plus or minus, right? But not more than that for this year. On the next page, yeah, here it's the rates. We kind of discussed this. So we're in a range right now, but it's a wide range of 50, 60 beeps, right? So, and as I was kind of saying, buying duration around 350 for 5 and 10s makes total sense, and that's where we are right now. So we think that's going to go well. So on the next page, it's our scenarios that we're kind of updated lately, right? This is our base case. Our base case really is 60%, right? So slightly more than 50%. So we're expecting a soft recession. So that's kind of what we're working on, right? And we think that spreads, and even on the preferred shares valuation, we think it's already reflecting that we're heading toward this type of scenario. So in that scenario, yeah, the bank, like I was saying, and the Fed, they'll be done by June, right, this year of hiking. The Bank of Canada, for us, we think they're done. And like I was saying, spreads, yeah, we could see some volatility. However, I think that's what important to mention and highlight is this hard lending scenario is for us is increasing. It started like 6 months ago, was maybe 15%. Now we're at 25%. And honestly, the more we're seeing good numbers on, well, high inflation numbers, really like great job creation. This at this time in the cycle, after hiking that much, for us, we think that could force the Fed to continue to hike, and this is just increasing the risk of hard landing, right? So right now we're just at 25%, but that thing could continue to increase a little bit. So I think that's important to highlight. And if, of course, that happens, spreads should widen. Equity will not perform well, same as preferred, and rates will go lower, right? So I think that's really important to highlight, and that's kind of how explaining why we like bonds so much right now. On the next page, here I wanted just to highlight what could impact rates on the higher side and the lower side, right? If we start focusing on the left hand of that table, so what could impact rates higher? What's important to monitor is the inflation number, right? So no surprise here, inflation extremely important to look at the core numbers, right? And both central banks, they're telling us they want to go to 2%, so they'll do everything they can to go to 2%, not 3%, 2%. So that's really important. That's why we're thinking they're far from cutting rates, and right now that there's more to do in the US. Labor market, of course, extremely important to monitor, and it's working with a lag, but right now it's just really strong in both Canada and the US. So this is going to be important to monitor, and maybe also China that is reopening. This is inflationary, right? So that's going to be important to monitor on the impact on commodities and so on. On the other side, though, on why rates maybe will not increase that much. First, you have the slower growth, right? So we're maybe not seeing it right now, but it's going to work, right? We have to be patient. We're going to see slower growth both in Canada, maybe more in Canada, but also in the US. It's coming, right? So we just have to, maybe Q2 or Q3 story of this year, but it's going to happen. After that, well, all the geopolitical risk, it's not improving, right? With Russia, Ukraine, China, also Taiwan, many risks down there that could see so much reasons to see rates going lower in a real risk-off environment, right? So that's important to monitor, and demand, right? Each time we're seeing rates increasing, we are seeing a ton of buyers of bonds, right? That happened last September, October, right? Happened again this year, right? So there's a lot of buyers of fixed income here, lots of rates buyer. They like the yield. They like also the all-in yield. So we're thinking that this is just going to continue if rates continue to increase a little bit. So that's all stuff important to monitor. On next page here, I wanted to kind of highlight that on the spread basis, right? So we're at 175 right now, maybe 177, but pretty close to the most recent peak that we had in 2018, and slightly tighter than the 2015 and like last fall by maybe 20 basis points, but we're at really attractive levels. So like I was kind of saying, we could see some volatility if at some point the market start pricing a little bit of more chance of a hard landing, right? So we could see spread widen a little bit towards, let's say, where we were, but not more than that, right? And for us, like the focus what that we like with credit is really in the front end. So 0 to 7 year, that's where we like spreads in the front end. We don't think we're paid right now to go into the longs that are trading so tight. So that's kind of what we see, but we like credit spread, right? We like the carry, but yes, we're expecting a little bit more volatility and widening for the next few months and quarters. As for prep, right? So preferred shares, it was really tough last year, right? Down 18% for the overall market. Rate reset did slightly better, but of course it's almost the same, 17.8%. Same for the US pref, really difficult last year. And the biggest reasons for that was the credit environment, right? So yes, credit spreads for high G Canada was widened by 50 basis points last year. But when you go lower in the capital structure for, let's say, LRCNs and hybrids, which are same as preferred shares, right? Spreads widen even more, right? So for the LRCN market, on the low reset side, some of the issuance widened by more than 500 basis points last year. That's a huge repricing, right? And even the biggest reset, so for LRCNs and some from hybrids, the widening was in the area of 100 and 150 basis points, right? So that was a problem last year, right? And of course, we had many sellers during the year, right? ETFs, funds, this exacerbated the move. Just like always, when there's a soft market, there's sellers, right? And it happened again last year. And even like in Q4, when everything else in the world was doing better, Canadian preferred share was trading lower, mostly because of flows, because spreads were kind of doing slightly better at the end of the year, and yeah, because of the tax loss season.
Yeah, so, tax loss at the end of the year, and then once that ended, you saw a little bit more of a bid in there. I mean, as I mentioned, I think usually people anticipate if yields are going up, rate reset preferreds should do well. Is it just because they went up so much so quickly? The thought was that it would be very restrictive and be very difficult on corporates that selling really took place?
The higher rate environment, Jeff, was for the 5-year rate for the fixed reset was a big positive, right? The problem is that most of the resets at the start of the year, they were redeeming them, right? Because the resets were attractive enough, and they were still able to replace them with hybrids and LRCNs, right? So we're just starting to see some issuance being extended, right? It started, let's say, around September last year. And so we're starting to see the benefit of that, right? So, but it's working with a lag, and I have some great slide later on, but.
Right, so it takes a little while for that higher yields to catch up and be reflected in the preferred shares. And you mentioned that extension risk. So in 2020, 2021, the issuers were redeeming at par because they could issue LRCNs. But then as yields went up, that trade-off wasn't as attractive. So instead of redeeming them, they just chose to extend them. Is that what happened?
Depending the issuers, right? But I would say, generally speaking, for banks and insurance, what these guys are looking at is the economics only, right? So they look at the reset level, right? So if they're able to replace a $25 pref reset and to replace it with either an LRCN or an institutional preferred shares, they'll do it, right? That's why they stopped last fall to do it. TD and National Bank decided to extend some. CIBC again early this year, right? Because it makes no economic sense to redeem them. As for the non-financial, though, these guys are more looking at all in, right? So some of them don't need capital, like Pembina redeemed one, maybe 3 to 4 months ago, right? But they're really looking at the all in because 2-3 months after they decide to extend one with similar reset because rates were slightly lower, right? So it all depends, right? But for us, we think that story of seeing a lot of redemption is done. But we could see on and off here and there for some non-financial issuers, right? Or if the market don't improve on the LRCNs and hybrids at some point, I would see this as maybe in 2024, 2025, that we could see some preferred share redemptions from the bank and insurance. But honestly, right now, don't expect much. Spreads are just too wide.
Okay. So on this chart, we see, the good 2020, the excellent 2021, the tough year of 2022, but a big start to this year, up almost, 7-8% in the preferred share space. Do you see that as just a little bit of a catch up from 22, or what would you expect possibly for the rest of the year? Is it almost like a reset now, where you're hoping to get the yield plus a little bit of appreciation on top of that 8, or is it some of that built into the 8?
I think this year's strong performance to start the year is a reflection also what you're seeing elsewhere, right? Equity is trading better, credit spreads are tightening, high yield spreads are tightening, preferred shares in the US also tightening, right? So spreads tightening and trading well, right? So that's really what's going on, right? Reset spreads are credit spreads are tightening for hybrids and RCNs. This is a positive. Rates are back up for the 5-year above 3.5. That's great for fixed resets. Of course, not necessarily great for perpetual, but they're kind of still okay. But it's not buyers. We're not seeing buyers a lot, right? But there's no seller, right? That's important, right? We used to have just sellers last year. Now the sales are done, right? But we're still waiting for the buyers.
Okay, good.
Here I wanted to kind of show that active management is so important with this asset class, right? It's up for the same banks. That the selection of the resets or towards perpetual, or also the timing, right, of the reset, it's so important for this market. So I want you to kind of look at the 2022 column, right, which is the let's say the third one, starting from the left side. You can see like banks last year was really terrible, right? 2020 they were underperforming the universe, right? 20% plus lower, whatever the resets, right? Of course, Q4 was difficult for the bank, mostly after the TDs and national bank decisions to extend, right? So before that, the market was still hoping that those pref should $25 pref should get redeemed over time and replaced by LRCNs and institutional preferred. But with the repricing of those LRCN and institutional preferred, banks have decided to take a pause, right, on this. So it trade from potential chance of being redeemed to no chance at all, right? That's what happened in Q4. As for insurance, you can see here, which with the Manulife example, that's perpetual last year was really difficult, 20%, 21% down, just like resets almost, right? However, this year they're doing really well, right? So of course, it started the year when rates were decreasing, spreads were tightening. There was many reasons to explain why perpetual doing so well, but since then rates are moving back up. Long rates are as much as high as where we finished the year, right? And spreads are that attractive, like not performing that well in the long end. So for us, we think it's a bit surprising to see perpetual trading that well still with the repricing of the rate market. So we'll see, right? Also, a big theme last year was the floor issuance, as you can see for the Enbridge, Pembina and Enbridge example. Clearly, like the floor issuance performed extremely well, which is also a little bit surprising because what the floor gives you is a hedge if the 5-year rates decrease, right? But it's totally not hedging you if spreads are widening like what happened last year, right? So it's good to have a floor at 1%, right? But when the 5-year rate is at 3.5%, this 1% hedge is far, far away from the current rates and level we're in right now, right? So you're going to be protected just if rates move lower than 1%, right? So anyway, they performed really well last year. It's good to see that this year they're not performing as well, but for us, we think that they're really too expensive, these issuance. $2-3 each of them versus a non-floor for the same issuance. So that was important to also to highlight. And on this page, yeah, we can fast forward on this page. I wanted to also to here you can see a bunch of LRCNs, hybrid issuance, and institutional preferred shares issuance, right? And you can see that it's not because it's trading OTC for the bond market that you don't have volatility, not at all. Like just last year, you can see some of the issuance that were down more than 19%, pretty close to what we saw with the pref market. So that's extremely important to monitor. And also what I was kind of highlighting a lot to you towards these webinars is finally last year the bond market realized that the reset level is important, right? And you can see it for the first two issuance on this table. For the first one is an issuance with a big reset, so 414 almost, right? As the second one, around 365, the reset is lower, and you can see the difference in performance, right? So the bond market start pricing a lot of extension risk for the lower resets, which is what the pref market has been pricing forever, right? So I think that's really important to highlight. And you can see here on the table, like, of course, the lower resets really on the performance, 500 plus basis point widening versus 180 for a better reset, right? So that's big difference. This year so far, it's risk on, spreads are tightening, right? 40, 50 B, depending which one you're looking at. However, in absolute performance, as rates are increasing at the same time, it's not as much as they're not performing as much as the prep, right? So they're lagging, right? So for us, we still like them, most of them, but clearly they're lagging the upside we're seeing in the regular $25 prep market so far.
And I like this slide. Are you really showing how the market has evolved, and you're really looking at all these different asset classes now, and that's why we've given you flexible mandates within the active preferred share mandates that you manage for us.
Yeah, that's important to highlight, Jeff. I fully agree. Since 2017 of the first issuance of an hybrid, in 2020 the first issuance of an LRCN, right? You can see that the market is evolving extremely fast, right? And you can see that on this table, like 5 years ago, the regular pref market, which is the blue and orange bar, was around 60, well, with the floating around 70 billion, right? So the gray part, so 70 billion. And now, and when you combine all three, float, the orange, the blue, we're slightly below 50 billion. So yes, maybe some weakness in the market, but a lot of redemption too that happened in 2021 and 2022, and also 2020, right? So, but they have been replaced with a bunch of hybrids. The blue, the light blue, which it's 13% now, it's 11 billion right now, and the green, which is LRCNs at 25% of this market, right? So, and it's important, and honestly, that's where we think the growth will be down the road towards those LRCNs, institutional preferred, which is like the red one, the red table, and a hybrid. This is what we're going to continue to get. We're at what, 37 billion, all three together that trade OTC. So it's not half and half, but it's getting there. Expect that this will be half and half at some point, maybe in 2-3 years. And the good news is that in both HBR and HYBR hybrid, we can buy this market, right? And I know some of this is going to be treated interest income like the hybrids and LRCN, but I agree, but we can have access to better issuers, right? We can have access to these new banks, high coupons, big resets. Same for, we can have access to, let's say, Rogers, that will have never print a prep, but now they're in this hybrid market, and yeah, we could see another issue at some point this year, right? So you're getting access to diversification of issuers, you're getting access to more liquidity than the pref market, right? And you're also getting access to a less volatile market. Maybe not when there's big movement like last year, but the daily vol is totally not influenced by these little flows in some ETFs, right? That we can see sometimes, right? Some days. So I think that's important to highlight. And also that by being active, like I was saying, we can buy this. ZPR, BMO, they cannot buy this. CPD,
right, it's giving you the option to find the best opportunity out there.
Yeah, it's giving us the options to buy the good resets at great yield, right? As you can see on this table, the green dot and the dark green dot and the light green dot. This is January 31st update. So honestly, all of them are not trading with better yield. We're slightly above 7 for all of them now, right? So it's great yield, and and here it's just the one with big resets or hybrids that we're expecting a high likelihood of being called on the first call date, so less extension risk. So you can have access to nice, attractive 7% yield, right? So and great names, right? And I also highlight here HEB. HEB now with the recent move in rates, the average yield to maturity is 5.5%. This is attractive. HFR, lower duration, the yield, the average yield is getting close to 6%. We're at 5.95 this morning, right? So these are also attractive yield, and we're able with HEB to get a better yield than this 100% triple B curve that you can see on this table, right? So, but HEB is what, 47% into triple B, 5% double B, the rest is A and double A, right? So active management is also extremely important for bonds, and that's what we are also doing for these two funds.
And HFR and HAB and HMP on this slide are the fixed income mandates Fiera runs for Horizons ETFs. And I know you and your team also believe in the opportunity in bonds and have been using the term bonds are back, and you're seeing that attractive yield that they're providing now after many years of such a low yield, and then the potential for some upside as well if and when the yields start trending back down.
Yeah.
So with the preferred share, I love this table showing what some of the rate resets will do.
Yeah, this is the best slide of the deck today, I think. And this is the most important slide. And this is showing you what type of upside for the average yield you have for HBR down the road, right? And I wanna highlight the fact that we're starting with a yield of 5 3/4. What's that yield? It's the current yield right now, right? So all the resets that we own that reset in 2020 during COVID when the 5-year rate was at 0.5%, that's the yield we're taking right now. Okay, so what's great with this is that over time, when all your resets will reset and not being called, just extended, right? But at this new rate environment that we're in right now, which we think this 3% is possible that we'll be in this 3% for a while, right? With this new inflation environment that we're in, that maybe they won't be able to cut rates below 3%, right? So there's a high chance that 5-year rates stay around 3 for a while. So if you're patient enough, and that's what's important, right? The HBR yield will reset over time towards 640 in 2024. So what's that? So all the reset that happened in 2023 and 2024 reset with a 5-year rate at around 3%. Your HBR yield moved from 5 3/4 to 640, and so on. So you can see that from now to the end of 2025, the upside for the current yield is 150 basis points, right? And of course you have upside, right? If you think no, it's not 3% that will reset over time, but it's 350 like we are right now, or even more, that's even better for the yield of HBR. Of course, that's assuming that we're not going into a hard landing and spreads are widening a lot. But I just wanted to show the upside potential, right? And if you say, no, Nick, just let me finish. If you say, no, Nick, forget about it, rates going back towards this 1.5%, right? And you can see here, right, on the light blue, you can see that even if that happened, HBR yield will improve and increase towards the 6 handle by the end of 2025. How is that possible? Because remember, in 2020 and 2021, we were resetting a lot of these with extremely low 5-year Canada rates. So that's the story. You have okay yield to start, but you have huge upside, huge over time as resets are going, right? And this 7.3% in late 2025 after tax, you're 9.5%, right? So this is really attractive yield.
That's right. Great reminder that that's a tax efficient yield when it's coming from preferred shares with eligible dividends. And so right now the 5 years at around 3.5 or even slightly above. You were pointing out if it were to end up sort of in the 3 range, they're resetting in 24 and 25 at sort of mid 6s and then even low 7% ranges then. And that brings me to one of the questions a viewer had, and that with the floating or rate reset preferred shares, they're wondering how they would perform if the rates are to go down significantly. And I think you talked about that there at sort of the 1.5. if the 5-year were to go back down to sort of 2, 1.5, 2, or even lower, what would you expect?
If rates, depending what's the reason why rates go down, but if rates are going down because there's less inflation pressure, right, and we're back to target, and that the bank doesn't have to stay above 4% and go back below 3%, right, and even lower than that, I would suspect credit spreads will tighten a lot, which will benefit, right? So what I'm trying to say here is that there's a lot of bad news price right now in this market. As you can see, even if rates go back to 1.5, you're still getting your 6-handle dividend yield, current yield, zero capital gain here, just talking about the yield, right? But of course, if we're going back towards 1.5%, because now it's a hard landing, they hike too much, it's a really big recession, and spreads widen also at the same time, that's not good, not gonna lie to you, right? So that's the risk for pref right now. It's hard landing, just as it won't be good for equity, for credit spreads, for high yield, it won't be good for pref if you're expecting a hard landing right now.
Right, and if that was someone's view, bonds would be a better option, investment grade.
Of course, you want to buy HEB. You want to fill your truck of HEB right now, if that's what you think, right? That's why we like duration right now.
Good.
So
Thank you.
As for this slide, I think that's an important to highlight, because the 5 3/4 right now is just okay, right? So when you compare with HEB bonds, corporate bonds at 5.5%, so just 25 beeps away, right? So when you look at the spreads at 250, you say, well, prefer not cheap, Nick. What do you think, right? But again, you have to kind of be patient, and this potential 150 beep upside, right, in the next two year and change, that kind of is a better reflection of maybe we're trading around 400 right now, right? And if rates move lower by towards the 1.5 year, yield is sitting around 6, right? So the real spreads you are right now, it's just you can't see it, but it's more in the 400, right? So that's what I wanted to kind of show you on this table. And on the next page, really, I wanted to highlight, I know spreads have widened, and that's the reason why preferred was really difficult last year, but you can see like the gray line, which is the Canada 5-year, the blue line is not following that move, right? The market should be stronger on this higher rates environment, at least for the rate reset, right? So it's like the pref market is telling you, no, rates will go back towards normal, towards the 2%, and soon, and we're not so sure about it, right? So if you agree with that, that's why the prefs are so attractive, but you have to be patient. On this page, I think just last year, it was really important, the numbers of issuance of LRCNs from the banks and insurance, and in same for in social preferred. Banks have and insurance, they have issued more than 10 billion last year, right? So and they keep on repricing the market each time, because the market was soft. They needed to go with wider spreads to be able to sell these, right? So that also impacts the pref market, right? Like I was highlighting at the start of the webinar. However, this year we won't get as much of LRCN issuance, which is good, right? So BMO, as you can see on this table, they've done an institutional pref early in the year. This is done, right? They don't have to do more, right? So honestly, this year, what you should expect is potentially RBC printing an institutional preferred, right? So this is going to happen. When timing it's unclear, but it's probably sooner than later, because they also have some LRCN to do, and to fund this HSBC Canada acquisition, right? So I would suspect that the institutional preferred share will be issued in Canada. However, banks and insurance, they have the possibility to print their LRCN in the US, and right now it's trading tight in the US. So we might not have much issuance, right? So we could see Manulife printing an institutional preferred this year, same for National Bank, but we might end up around 3-ish billion for the full year, not 10. So this is a big positive for this year.
Nick, do you want to just take a moment? Can you take a moment to explain an institutional preferred share and if you have access to those?
Yeah, well, since 2020, banks have the possibility to print LRCN, right? And the big advantage for banks to print LRCN is it's interest income, right? So instead of dividends, so they're saving on the tax a lot, right? But OSFI put them a cap of how much they were able to print of LRCN. So this is pari passu to pref. It's in this AT1 bucket, right? So some of the banks were kind of capped, like BMO, like TD, and soon Royal Bank, right? And OSFI gave them the opportunity to remove that cap if they issued institutional preferred shares, which again, it's exactly like a pref, but it's trading over the counter like the LRCN, so trading through the bond holders. But the institutional preferred, the biggest difference, it's perpetual, like a pref, and it's dividend income. So it's really the same thing, right? So and some of these banks have removed that cap, like TD, like BMO, and yeah, because they've issued so much. But let's say for RBC in this table, right now they just have room for 900 million of LRCN, right? So if they want to do more to help funding these acquisitions and other stuff of what they've been doing, they have to print at least 1 billion of the institutional pref, and now after that they'll be able to print as much as LRCN as they want, right? So for HPR, for Hyber, we can buy all of that. We can buy LRCN when we like the level. We can buy the institutional preferred with the big resets and above 7% coupon. We can buy the hybrids. We can buy them all, right? If it makes sense. So that's great. And I think for retail, they're extremely difficult to find these. And if so, they're not trading at par when for us we were able to buy on the new issuance.
Right, because you're institutional access and you're one of the largest preferred share buyers in the country.
Exactly. As for the $25 pref market, honestly, it's been a while that we saw an issuance, and don't expect supply on the reset side, as the hybrid and the LRCNs are better avenue for these issuers. So we could see down the road some perpetual issuance, but maybe we'll need to see lower rates environment for them to be convinced to print one. So we're not expecting a ton of supply this year at all. We're not expecting at all. On the next page, I wanted to kind of highlight and show how flows are important within this small asset class, right? We saw that 2021 was a great year, right? And yeah, there were also many buyers, right? And last year was extremely difficult, and it was exacerbated by these moves, these sellers, right, of both passive and active ETF. But this year so far, it's almost flat, and this is as of January, and as of yesterday, it's net outflows still we're seeing, mostly through the passive ETFs. But for us, we're expecting, usually buyers are back when after a really bad year, right? So we're expecting them to be back. But of course, this macro tone and the market environment is a bit challenging, right? So but not seeing sellers is just good, right? It's enough, right? Because this asset class, it's really tough to sell, right? But it's also really difficult to buy the good ones, right? And that's important, and that's why the market repriced so fast in January, right? So if for whatever reason we're going back in this potentially like less pressure on inflation and everything is okay and the soft lending is possible, pref market will like it, right? And just like other risky assets, right? And it will jump back really fast, right? On not much volumes, right? So that's why the flows here, it's really important to watch.
Right. And then one of the advantages, of course, of a preferred share ETF is having that liquidity. As you mentioned, it's very difficult to buy individual preferreds, and also can be difficult to sell. So, of course, then the benefit of the liquidity of being able to buy that preferred share ETF. And just a quick overview of HPR, the Horizons Active Preferred Share ETF. As we've said, Fiera Capital, Nick and his team are the sub-advisor of this ETF. Management fee of 55 basis points, which is quite low for true active management. It's only a little bit higher than the passive benchmarks. And of course, as I mentioned, the yield off of these ETFs are primarily tax efficient as Canadian eligible dividends, and right now the annualized yield is about 5.4% from the ETF. And as Nick said, if yields stay in this range, Expected to see the rate resets set higher in the coming years. HPR is primarily preferred shares, blend of rate resets and some perpetuals, but it can have the ability to have some LRCNs in there as well.
Yeah. So on this
go ahead,
page,
Nick. I love this slide.
Yeah, we can go in more detail of what we are doing and where we see value in the pref market, right? I want you to kind of look at the table on the upper right side. We're on the weight perpetual, right? So we're at 16%, market the weight is around 25. It was not necessarily the best trade so far this year. It was great last year. This year, not that much, but pretty confident that some of these perps should weaken a little bit, right? With the recent move in rates that clearly the market is not really looking at, right? So we're confident with that trade, and we just think there is way more upside in yield with the fixed resets, including the floating and the hybrids. As you can see, bonds and hybrids, so this is including NRCNs, we're at 6% right now. So in HPR, when you have these institutional preferred shares, we're getting close to 9%, right? Total, right? So these institutional preferred, as they're preferred, we're treating them in the fixed floating bucket, right? So right now, so you can see them in this bond and hybrid. So it's around 9% of these, right? So we like them. Like I was saying, it's mostly big resets, and the average yield to call for some of them are because we think they're gonna get called. It's all above between 7 and 8%. So really attractive yield, right? So after that, what I wanted to show here is the table below on the left hand side, right? You can see we have a lot more of the preferred shares, so the $25 ones that trade at discount, right? More than the universe, so more of the one that trade below 20%, 21, and so on, right? So and this is the reason, and maybe we'll go later, but these are all the preferreds that if rates stay the same, we don't need rates higher. Stay around 3%. So even if they go back from 3.5 where we are to go back towards 3, it's okay, right? These are the ones that have a lot of upside, right? And you don't want to be into those $25 pref. Now they have no upside, right? So you want to be in the ones that trade at deeper discount, right? So we have a focus on quality. We're expecting a soft recession. It's not the time to be cute and buy Brookfield properties and Fairfax, these type of names that weaker credit, right? So no, it's time to focus on quality. That's what we've been doing in HPR. So in the utility, that's names like CU, Brookfield Renewable Power, right? In the telecoms, that names like Bell. Bell is extremely attractive, or Rogers hybrids that we own also. As you can see, we have a big underweight in real estate. That's the Brookfield properties mostly, and Artis REIT, but mostly it's Brookfield properties. We think this name is a risky name, right? So we don't want to be. We want to stay underweight this issuer, right? So insurance, it's really mostly Manulife, Sun Life, and Great West, so the big three, right? So that's important. It's not Fairfax or let's say Parfin Park. We prefer to be into the Great West for the same yield most of the time, right? So prefer to be closer to the assets. And yeah, energy, that's Enbridge, that's SRAP, that's Pembina, that's Cenovus. Cenovus, we could see some redemptions at some point, right? They were totally not trading like that. So I'm not telling you they're going to redeem them, but it's not impossible. These guys, if oil stays that high, they could decide to redeem some. Maybe they won't need as much as capital and equity. So we like that name a lot. And banks. On the bank side, we're mostly into these lower resets and mid resets, and mostly in the ones that reset in 24 and in 2025. These are the ones that are cheap. And that's kind of the trade we have right now in HPR. Yeah. On the next slide, you can see what I wanted to highlight. Like average spread is still similar to the benchmark, but you can see on the left, bottom left table, right? You can see that we have more of those mid to low resets. Let's say the 200 to the 300, between 200 and 300. That's where we find value. And also we have started to build this overweight position in these big resets, but not towards Brookfield properties or Fairfax, no, towards the banks, insurance, and some hybrid, right? So towards big quality names of RLRCNs and hybrids. So that's really important to highlight. And And the timing too is really, really important with the pref market. You can see some of the reset with the latest move in the 5-year rate move, because they were resetting now, or they just reset it 2 days ago, like the Manulife issue. The timing is really important, and move up by $1.50, because now the market was happy to see a really nice coupon, right? So that's exactly what we're expecting with those 2024 and 2025. At some point when the market, when they will reset, and if a 5-year rate is still around 3, there is a lot of upside with these, right? So, but it takes time. So that's what I've kind of been saying for a while now.
Nick,
Yeah.
I have a question that's come in that might be addressed on this slide. Do you have the average spread of the preferred shares over bonds? Has that gone up, and do you anticipate that continuing to go up with the rate resets going forward?
For HBR, it is going up. It was in the low 270 not long time ago, right? So because we're able to buy hybrids and LRCN and institutional preferred, that the latest issuance the resets were all above 400 beeps, right?
Okay.
So yeah.
So and I guess that's the question. If in a normal environment, the rates, the 5-year goes back down to 1.5, 2, would these preferred shares still be paying sort of in that 5-6% range?
Well, the coupon will decrease, right? If let's say the latest issue that was issued at 7%, and that you reset in 5-year and the rate is 1.5%, well, you will probably move from 7 to 5.5%, let's say, assuming your reset is 400. So
Okay.
That's assuming you're not getting called, right? So
Right.
that's
Okay.
for this issuance. But for the average yield of HBR, as I was showing, even if rates move to 1.5% tomorrow morning or this afternoon and stay like that for a while, the average yield of HBR is increasing, right? Because a lot of resets that reset in 2020 with a 5-year at 0.5, well, even if we're at 1.5, too bad it's not 3, but it's not 0.5, it's still better, right? So that's why you have upside with the yield, the average yield. So when you combine all the funds, all the positions we have, even if rates decrease towards 1.5, there is an upside in the yield, right? So that's important to add.
Okay. And just an overview on HYBR, HYBR, as we call it. It's the Horizons Active Hybrid Bond and Preferred Share ETF. And as the name alludes to, it has a lot more flexibility. It can be in hybrid bonds, LRCNs, preferred shares, the best opportunity that you can find to be able to try to provide a very attractive yield with some upside. Again, management fee of 55 basis points, and annualized yield from the ETF right now of around 5.2%. And then the breakdown of this, and I love the chart on the lower left where it shows you the valuations we talked about earlier on the call, that you're able to find good valuations of some of these preferred shares trading at attractive prices.
Yeah, this fund, someone sometimes asks me, what's the difference with this one, HYBR versus HBR, right? HYBR is more a tactical ETF, right? So we can be invested 100% into these hybrids and LRCN if we want, right? So we can have $0 $25 pref if we want, or we can be 100% into these $25 pref, right? So we can really move a lot, right, within this ETF. So right now, like as you can see on the upper right table, right, we don't have much per. We're at 5%, right? And we were slightly higher. We started reducing some, and that's not a long time ago. That we're just trading too high in price or too low in yield for us. So and we have more hybrids than LRCNs, right? So we're at almost 11%, right? HBR, remember, it was around 6, so almost double, right? And when you include the institutional preferred, we're at 15%, right? So we have more of these in this ETF, but the rest is pretty similar. If we like a name, if we like, let's say, CU or Brookfield Renewable Power, we're gonna be overweight in both funds, right? So and we don't have the slides, but you can see with this also the similar trade with the mid resets that we prefer. So resets between 200 and 300. The timing of resets, we think there's way more value in the ones resetting in 24 and in 25, right? So that's exact same thing. It's just slightly less per, more hybrids and bonds, right? So this fund will beat HBR if rates stay where we are or if rates continue to increase. However, if rates go back lower because we have more perp into HPR versus this fund, HPR will do better, right? So it all depends on your views here, right? So both are.
And I think you stole one of the questions. Is some people were wondering on your thoughts of which one would do better.
Depending on your view on rates, but right now, for us, if you are patient enough and wait 12, 18 months, we do think at some point rates will go back lower, right? So HPR should be the one.
Okay. Oh, and this is again showing the yield sensitivity for HIBOR.
Yeah. So you can, if you do the math, you can see that we have slightly more upside if rates stay where we are, around 3%, let's say, and of course more upside if rates go higher. And yeah, so it's a really similar picture showing on this slide.
Yeah. And back to your sort of your recommendation for either, but in summary, the average yield in both of these ETFs is quite attractive and can also provide some upside in yield and maybe even in capital appreciation. So is it your assumption that Canada 5-year will remain around 3 for a while, and then therefore the yields in these ETFs and the rate resets within these ETFs will increase up into the 7% range? Is that correct?
That is correct. We think, yes, shorter term, right? If we keep on seeing strong numbers, yeah, we could continue to see some upside pressure on the rates, right? That's just what we've been seeing lately, right? But over time, right, over the next 12, 18 months, it won't be necessary for the Bank of Canada to be in this tightening and territory, right? So the bank and the Fed at some point in 24 and also in 25, they're going to cut rates. So, but we're in this new world of inflation not going back to 2%, right? So we'll probably stay in this 2 to 3, right? And that's why we don't think the bank and the Fed will be able to cut rates below 3 at some point, right? So right. That being said, that's explaining why the 5-year rate, hopefully at least for the next 2-3 years, will stay around 3, right? It won't go much lower than that. So
are the days of the 0 to 1% yields or rates, Bank of Canada rates, are those gone for some time, or if not forever?
I would never say forever. For some time, yes, there are geopolitical risk out there, right? And this could be inflationary. We might build more of our stuff in Canada, US, less in China. So and there's inflation too in China. So we think this world that we were living with low inflation and zero pressure on the goods is behind us, right? So yeah, inflation should be more sticky around 2-3 down the road, and if that happens, the banks won't be able to cut rates towards these low levels we saw, right? Not long time ago, of course. That's assuming we're not in a huge crisis, that's of course, right? But at least for the next 2-3 years, there's a big chance that rates stay around 3 for the 5-year. So yeah, and this is a sweet spot, right? For the pref, of course, it's higher, that's better. But sometimes if it's higher, maybe it's credit not doing that well. So let's hope credit do well. Credit does well, and then spread and the yield stays around 3, and that's the exact sweet spot for the pref market. But that being said, as you can see, we will have volatility. We had some, expect more, right, for the pref market. It will follow the equity market on that. That's like always, right? So, but the yield is attractive to start, but the upside is extremely important. But you need to be patient, right? So there might be some
volatility, but the opportunity is there.
You try to time it and sell now and buy when this prom is out. Yeah, maybe, but it's really tough to do. This as a class is illiquid. When the market will start buying this story of, oops, this 2024 resets and 25 resets are attractive, it will be too late to go back.
It'll be priced in at that point. Okay. I just wanted to quickly show the performance of both the mandates we've been discussing. You'll see the year-to-date number. That's to the end of January. A nice start to the year. following a tough year last year, which includes the 1-year number. But if you look at the 3-year number, sort of the 4.6 or 5.5% from these mandates, those are attractive returns, and that's a lot better than the aggregate bond index, which I believe is sort of either flat or even slightly negative over a 3-year period. So sort of doing what it's supposed to over that 3-year period. I just wanted to provide an update or reminder to advisors on the call that we do offer the potential for an in-kind transfer process. So if you have some single line preferred shares and you'd rather have the diversification and liquidity of an ETF, of HPR or HYBR, we can look to take those in kind and provide you back equal amount of HPR with certain restrictions like a minimum. But that basically helps you with liquidity on both sides, but it is still a taxable event. And before we get to the questions, I'll just remind everybody that we're social. Please reach out to us if you have any questions or if you need more information on this webinar or either of the ETFs we've discussed. This webinar will be sent out to everyone who registered a replay within 3 to 4 business days. So you will get the audio recording with this presentation. But you can give us a call on our 1-866 line or email us at info@horizonsetfs.com or reach out to the sales team that covers you in your region. We're also on Facebook, Twitter, Instagram, and LinkedIn. And we will get to a couple questions, but we're almost out of time. But I will look at some questions. A lot we've answered some already. There's of course some questions on some individual preferred shares. Nick, with your expertise, someone asked about the BCE Prime floaters. They're yielding about 8.5%. Are you interested in those? Do you own those?
We own some. They're cheap. Of course, at some point, Prime will not be at 6.7. It will go down a little bit, right? But probably stay above 5, right? So yeah, the yields on them are attractive. Price are low, right? In the $18, $19. We like them. We like BC credit. It's trading really well on the bond side, almost flat to banks, right? So in the 5-year. So okay. Yeah.
Okay. Another one, BRF.C, trading pretty cheaply. Do you know that one?
Yeah, we own that one. It's a big overweight. BRF A and C's extremely attractive, right? Again, on the bond side, this entity is trading much tighter than the BAM entity, while on the pref side, it's the opposite, maybe because of the rating. The BAM is P2, the BRF is P3, right? But we really like the credit, and it's trading with really attractive yield now and huge upside. The C's is around 9, the A is around 10. So okay. The reset one is in 24 and the other one in 25. We like both. It's a big overweight in our fund.
Okay, good to know. An interesting question: Do issuers buy their own preferred shares in the secondary market?
Yeah, that's a really good question. And as much as we start seeing a lot of issuers buying back their debt last year, right, at discount, we think that that's also something that could happen in the pref market, right? So some of these issuers, and some of them it's all public, right? They're saying the NCIB on the pref, right? And they were not really doing it in the past, but we think that they might consider it more and more with the resets of these coupons getting higher and higher, right? So yeah, we're expecting a little bit of that this year. And this is going to help sustain the tone, right, on this market.
Good. And we just had a couple questions asking about comment on HLPR, and I would just let everyone know that HLPR, offered also by Horizons, is a passive index, the rate reset index, and it's in our total return corporate class structure. So Fiera is not the sub-advisor on that. That's a true passive index on the rate reset preferreds. So doesn't have the flexibility that Nick was talking about in being able to go in between rate resets, perpetuals, LRCNs, hybrid bonds, etc. And then I think, Nick, that's it. Well, we're going to end there. So I really appreciate your time and your expertise. You've done a great job for us, and we're thrilled with our partnership and our continued growth with you. And thanks to all of our listeners. You've been a big part of the growth of ETFs in general and Horizons ETFs, and we really do appreciate that support. So if you do need anything, again, please reach out to us. We'd be happy to help. And if we didn't get to everyone's questions, we'll do our best to reach out to you after the webinar. And with that, we'll end. So thanks again, Nick. Thanks to everyone who listened in. Hopefully we presented the opportunity preferred shares are providing with the yield and potential upside. And happy investing. Thank you.
Thank you.